Zero rate cuts. That's the Fed's message right now. And if you're holding equities in 2026, you need to hear this immediately. Here's what's really going on and what you should be thinking about right now. Jerome Powell just drew a line in the sand. No rate cuts coming, not soon, maybe not at all this year. Markets are pricing in hope. Powell is pricing in reality. Those two things cannot coexist for long. Higher for longer isn't a phrase anymore. It's the policy. And every day rates stay elevated, valuation multiples on growth stocks face compression. That hits your portfolio directly. 10-year Treasury yields are staying stubbornly high. When bonds pay you serious income, equities have to compete harder. Right now, they're losing that fight. Rate-sensitive sectors are getting crushed. Real estate, utilities, high-debt growth names. These are the positions bleeding out in slow motion while the Fed holds the line. Then Trump enters the picture. He publicly stated he doesn't care that Powell is staying. That kind of political friction doesn't just generate headlines, it generates volatility. Institutional investors hate uncertainty, and right now, there's plenty of it. The VIX is paying attention even when retail investors aren't. Smart money is hedging. Are you? But here's what nobody is saying about this yet. The real risk isn't just the rate level. It's the credibility war. Powell is fighting on two fronts simultaneously. Inflation on one side, political pressure on the other. If markets start believing the Fed could blink, could cut rates prematurely under political pressure, inflation expectations reprice overnight. That scenario is arguably worse than rates staying high. You'd get the worst of both worlds, persistent inflation and a destabilized Fed. Bond markets would revolt, equity risk premiums would spike, and portfolios built for a soft landing would get blindsided. The mainstream narrative is focused on when do cuts happen. The real question is, what happens if the Fed's independence is perceived to be compromised? That's the tail risk nobody's modeling right now. 3 things worth thinking through. Educational perspective only. 1. Examine your duration risk. Long-duration assets, growth stocks, long-dated bonds, REITs, are structurally vulnerable in a higher-for-longer environment. Know exactly what you're holding. 2. Consider what a yield spike does to your portfolio. If 10-year yields push higher from here, which positions absorb the most pain? Run that stress test before the market runs it for you. 3. Watch Fed communication like a hawk. Any deviation from Powell's current language, any softening of tone, could trigger sharp, fast moves across asset classes. Positioning ahead of that signal matters. The Fed is holding firm, political pressure is mounting, and most investors are still asleep at the wheel. What do you think this means for your portfolio? Drop it below. This video is for educational purposes only, not financial advice. Always consult a qualified advisor.